You know what nobody's talking about? The fact that there's a completely legal way to own physical gold and silver that bypasses every single headache most people deal with. No premiums eating into your returns, no storage nightmares, no liquidity issues when you need to sell. And here's the kicker. Institutional investors have been using this method for decades while retail investors overpay at coin shops. I'm going to walk you through exactly how this works, why it's remained under the radar, and most importantly, how you can use it starting today. But first, let me show you why the traditional way of buying bullion is designed to drain your wealth before you even get started. Picture this. You walk into a coin shop or go online to one of the big dealers. You want to buy an ounce of gold. Spot price is sitting at $2,700. Seems straightforward, right? Except you're not paying $2,700. You're paying $2,850, maybe $2,900. That extra $150 to $200? That's the premium. And it's pure profit for the dealer. Now multiply that across your entire position. If you're buying 10 ounces, you just paid an extra $1,500 to $2,000 for the privilege of owning the same gold that's trading at spot price on the COMEX. And that's just the beginning of the problem. Let's say you hold that gold for 5 years. Price goes up 20%. You're feeling good. Time to sell. You take it back to a dealer. Guess what? They're not paying you spot price. They're paying you under spot, usually 2 to 3% below. So you paid a premium to buy, and you're taking a discount to sell. Your actual return just got hammered on both ends of the transaction. But wait, there's more. Where are you storing this gold? Safe deposit box? That's $150 to $300 a year. Home safe? That's a one-time cost of $500 to $2,000, plus the constant security risk. Insurance? Add another 0.5 to 1% of your gold's value annually. These costs compound year after year, silently eroding your returns. And here's what really gets me. You can't easily sell part of your position. You've got 1 ounce coins. You need some cash. You can't sell 0.3 ounces. You're selling the whole coin or nothing. Zero flexibility. Zero liquidity when you actually need it. So what's the alternative? What's this backdoor method that changes everything? Exchange-traded products backed by physical metal. But not the ones you're thinking of. I'm talking about a specific structure that most people don't understand exists. Let me break down exactly how this works and why it's completely different from what you've been told about paper gold. There are ETFs and similar products where every single share represents actual physical bullion sitting in a vault. We're talking about allocated metal, specific bars with serial numbers, audited by third parties. You can literally look up the bar list online and see exactly which bars back your shares. This isn't a futures contract. This isn't a promise to deliver. This is actual metal that exists right now. Here's where it gets interesting. When you buy shares of these products, you're paying spot price, not spot plus premium, just spot. The expense ratio is typically 0.17 to 0.4% annually. Compare that to the 2 to 4% you lose on premiums when buying physical coins. You just saved yourself thousands of dollars on a meaningful position. Let's run the numbers on a real scenario. You want to own $50,000 worth of gold. Traditional route, you're paying $51,000 to $52,000 after premiums. The backdoor method, $50,000. You just saved $1,000 to $2,000 instantly. That's a 2 to 4% return before the metal even moves. Now let's talk about selling. You want to take profits or you need cash. Traditional physical? You're driving to a dealer, negotiating, probably taking a hit below spot, waiting for them to test your metal. The backdoor method? You click sell. Execution happens in seconds. You get spot price. Money hits your account in 2 days. The liquidity difference is night and day. But here's what really separates the sophisticated investors from everyone else. Flexibility. You want to sell 10% of your position? Done. You want to rebalance between gold and silver? Takes 30 seconds. You want to dollar cost average and over time? You can buy $100 worth every week if you want. Try doing that with physical coins. The transaction costs alone would destroy you. Now I know what you're thinking. What about the safety? What if the system collapses? What if they don't actually have the metal? These are legitimate questions, and here's why this specific structure is different from the paper gold everyone warns you about. First, the metal is allocated. That means specific bars are assigned to the fund. They're not lending it out. They're not rehypothecating it. It's sitting in a vault with your fund's name on it. The big products use vaults like HSBC in London or JP Morgan in New York. These are the same vaults central banks use. Second, Independent audits happen regularly. We're talking about firms like Inspectorate that physically go into the vaults and verify the bars match the bar list. They check serial numbers. They check weights. This isn't some trust me bro situation. The verification is public. Third, and this is crucial, you can actually take delivery of physical metal from some of these products if you hold enough shares. Usually around $25,000 to $50,000 worth. So if things really go sideways, you have an exit to physical. But you're not paying the premium up front. You're only converting to physical if and when you actually need to. Let me tell you about what happened in March 2020. Remember that? Markets were melting down. Gold spiked to over $1,700. People panicked and rushed to buy physical. Coin dealers sold out. Premiums exploded to 10, 15, even 20% over spot. If you wanted a gold eagle, you were paying $1,900 for $1,700 worth of gold. But here's what nobody talks about. The people who owned these exchange-traded products, they were buying and selling at spot price the entire time. Zero premium spike, zero supply shortage. They could sell instantly if they needed cash. They could buy more if they wanted to add to positions. While everyone else was scrambling and overpaying, they were operating in a completely different market. That's the power of liquidity. That's the power of not being dependent on physical supply chains and dealer inventories. When you need to act, you can act. No friction, no games. Now let's talk about the tax situation, because this is where it gets even more interesting. Physical gold and silver are classified as collectibles by the IRS. You know what that means? 28% long-term capital gains rate. Not the 15 or 20% you pay on stocks. 28%. That's a massive tax hit on your profits. But certain exchange-traded products are structured differently. Some are treated as grantor trusts. Some are structured in ways that get you the standard long-term capital gains treatment. 15 or 20% instead of 28. On a $100,000 gain, that's a $13,000 difference. That's real money staying in your pocket instead of going to the government. And here's something most people don't consider. If you're holding physical gold in a retirement account through a gold IRA, you're paying custodian fees. You're paying storage fees. You're dealing with a whole administrative layer that costs money every single year. With the backdoor method in a regular brokerage IRA, those fees disappear. You're just paying the tiny expense ratio of the fund itself. Quick aside here. If you are sitting on $100,000 or more in retirement accounts and you're interested in how gold IRAs actually work, I put together a free guide. It's in the description. Covers the whole process, the fee structures, how to avoid the common mistakes. Worth checking out if that's relevant to your situation. But back to why this backdoor method is so powerful. Let's talk about what the big players are actually doing. You think institutional investors are buying gold eagles and storing them in safe deposit boxes? Absolutely not. They're using these exact structures. They're getting spot price execution. They're getting instant liquidity. They're getting tax efficiency. They're getting flexibility. I'll give you a specific example. There's a major hedge fund that holds over $2 billion in one of these gold products. $2 billion. You think they're doing that because it's paper gold they don't trust? No. They're doing it because it's the most efficient way to own physical metal at scale. They can deploy capital instantly. They can exit instantly. They can rebalance their entire position in minutes if market conditions change. That's the game the professionals are playing. Meanwhile, retail investors are overpaying at coin shops and thinking they're being smart because they can hold the metal in their hands. The emotional satisfaction of physical possession is costing them thousands of dollars in unnecessary expenses. Now let me address the biggest objection head on. What about the apocalypse scenario? What if the financial system collapses and you need physical metal to barter with? Look, if we're in a true Mad Max situation where the banking system is gone and society has broken down, we've got bigger problems than gold ownership. You're going to need food, water, ammunition, and community. Your gold coins aren't going to be as useful as you think. But let's say we're in a serious crisis that's short of total collapse. Currency crisis. Banking crisis. Major geopolitical event. In that scenario, you know what happens? Gold prices spike. And you know who can sell at those elevated prices instantly? The people using the backdoor method. They can lock in gains in seconds. The people holding physical? They're trying to find a dealer who's open, who has cash, who's willing to pay a fair price. Good luck with that in a crisis. I've seen this play out in real time. During the European debt crisis in 2011, gold hit $1,900. The people who could sell at that peak were the ones with instant liquidity. By the time physical holders got their metal to dealers and negotiated prices, gold had already pulled back. They missed the top because of friction in the system. Here's another angle nobody talks about: diversification within precious metals. You want to own gold and silver, maybe some platinum, maybe some palladium. With physical, you're buying different coins, different storage solutions, different dealers. It's a logistical nightmare. With the backdoor method, you can own all four metals in the exact allocation you want. You can rebalance monthly if you want. You can adjust your position based on the gold-silver ratio. Try doing that efficiently with physical metal. The transaction costs would eat you alive. Let me walk you through a real-world scenario. It's 2024. Gold is at $2,100. You think it's going to $2,500. You want to put $50,000 into gold. Traditional route? You buy physical. You pay premiums. You set up storage. Total cost? $52,000. Gold goes to $2,500. Your metal is now worth about $59,500. You sell. Dealer pays you 3% under spot. You get $57,700. Your profit? $5,700. That's an 11.4% return on your $52,000 investment. Same scenario with the backdoor method. You buy $50,000 at spot. No premium. Gold goes to $2,500. Your position is worth $59,523. You sell at spot. You get $59,523 minus 0.2% expense ratio over the holding period. You net $59,400. Your profit? $9,400. That's an 18.8% return on your $50,000 investment. Same move in gold, 65% better return using the backdoor method. That's the power of eliminating friction costs on both ends of the trade. Now let's talk about something even more sophisticated, using these products for tactical trading. You see gold pulling back to a support level. You want to add to your position. With physical, you're calling dealers, comparing premiums, arranging payment, waiting for shipping. By the time you get your metal, the opportunity might be gone. With the backdoor method, you're buying in 30 seconds. You caught the exact level you wanted. Or flip it around. Gold spikes on some geopolitical news. You want to take partial profits. With physical, you're locked in. You can't sell half a coin. With the backdoor method, you're selling exactly the amount you want at the exact price you want. That's the difference between being a passive holder and being an active manager of your wealth. Here's something else that's fascinating. Some of these products pay out the interest earned on cash balances or lending fees as dividends. So you're not just holding metal. You're actually earning a small yield on your position. It's not huge, maybe 0.1 to 0.3% annually, but it's something. Physical metal sitting in a safe earns you nothing. Actually, it costs you money in storage and insurance. Let me tell you about a guy I know who learned this lesson the hard way. He bought $100,000 worth of gold eagles back in 1929, paid about a 4% premium, stored them in a safe deposit box, paid the annual fee, held for 4 years. Gold went up nicely. He decided to sell in 2023, took his coins to 3 different dealers. Best offer? 3% under spot. After premiums on the buy, discount on the sell, and 4 years of storage fees, his actual return was about 30% less than the move in gold itself. He left tens of thousands of dollars on the table because of structure. If he'd used the backdoor method, he would have captured almost the entire move in gold. The only cost would have been the tiny expense ratio. That's the difference between understanding how the game is actually played and doing what feels safe but costs you a fortune. Now, I want to address something important. Not all exchange-traded products are created equal. There are some that are truly backed by physical metal with proper auditing and allocated storage. And there are some that are basically derivatives or futures-based products that don't actually hold metal. You need to know the difference. The ones you want are the ones that explicitly state they hold allocated physical bullion. They publish bar lists. They have regular audits. They allow for physical delivery if you hold enough shares. These are the real deal. These are the ones that give you actual exposure to physical metal without the friction costs. The ones to avoid are the leveraged products, the inverse products, the futures-based products. Those are trading vehicles, not ownership vehicles. They're fine for short-term speculation if you know what you're doing, but they're not the backdoor method I'm talking about. They don't give you true physical exposure. Here's how you verify what you're buying. Go to the product's website, look for the bar list. If they publish a list of every single bar with serial numbers and weights, you're looking at a real physical product. If they don't publish that information, walk away. It's that simple. Let me give you the exact characteristics you're looking for. Expense ratio under 0.5%. Allocated physical storage. Publish bar list updated regularly. Independent audits. ability to take physical delivery above a certain threshold, high daily trading volume for liquidity. Those are your criteria. If a product checks all those boxes, you've found a legitimate backdoor method to own bullion. Now let's talk about the psychology of this. There's something emotionally satisfying about holding a gold coin in your hand. I get it. It feels real. It feels safe. But that emotional satisfaction is costing you real money. And here's the thing. The safety is actually an illusion. Your gold coins in a home safe? They can be stolen. They can be lost in a fire. They can be seized. Your gold in a safe deposit box? The bank can restrict access during a crisis. They can raise fees. They can close your box if you miss a payment. The physical possession you think gives you control actually gives you vulnerability. Compare that to allocated metal in a professional vault with insurance, security, and institutional-grade storage. Which is actually safer? The answer is obvious when you remove the emotion from the equation. Here's another psychological trap. People think that if they don't hold it, they don't own it. But you don't hold your stocks. You don't hold your bonds. You don't hold your real estate deeds in your hand every day. You own them through legal structures that provide proof of ownership. The same applies here. Your shares represent ownership of specific bars of metal. The legal structure is actually more robust than physical possession in many ways. Let me tell you what happened during the 1933 gold confiscation. The government ordered citizens to turn in their gold. People who had it in safe deposit boxes. The banks cooperated with the government. People who had it at home? They were breaking the law if they didn't turn it in. The physical possession didn't protect them. The legal structure was what mattered. Now, I'm not saying confiscation is likely today. The dynamics are completely different, but the point is that physical possession isn't the ultimate protection people think it is. Legal ownership structures, diversification of storage locations, and liquidity to exit quickly if needed. Those are the real protections. Here's something most people don't consider. Verification. You buy gold coins. How do you know they're real? You need to test them. You need equipment, or you need to pay someone to test them. Every time you buy, every time you sell, that's friction, that's cost, that's risk. With allocated metal in a professional vault, it's tested and verified by experts using industrial equipment. The verification is built into the system. Let me walk you through what institutional investors actually do. They don't buy gold coins. They use these exact structures I'm describing. They get spot price execution. They get instant liquidity. They get professional storage. They get audit trails. They get tax efficiency. They get flexibility. And they pay a fraction of what retail investors pay for physical coins. Why would you play a different game than the institutions? Why would you voluntarily pay higher costs for lower liquidity and more hassle? The only reason is if you don't know this backdoor method exists. Well, now you know. Here's the action plan. If you're currently holding physical gold or silver, calculate your total cost. Include premiums you paid, include storage costs, include insurance, include the discount you'll take when you sell. Now compare that to what you would have paid using the backdoor method. The difference is probably shocking. If you're planning to buy precious metals, don't walk into a coin shop. Don't overpay online dealers. Open a brokerage account if you don't have one. Research the specific products that hold allocated physical metal. Verify they publish bar lists and have proper audits. Buy shares at spot price. You just saved yourself thousands of dollars and gained instant liquidity. If you want both, if you want some physical for the emotional satisfaction and some in the efficient structure for the financial benefits, that's fine. Just understand the trade-offs. Maybe you keep 10 or 20% in physical coins that you can hold, and you keep the bulk of your position in the backdoor method where it's working efficiently for you. The key is understanding that you have options. You don't have to play the game the way coin dealers want you to play it. You don't have to accept premiums and discounts and storage costs as inevitable. There's a better way. The institutions have been using it forever. Now you can too. Here's what this really comes down to. Efficiency. Every dollar you save on premiums is a dollar that's working for you in actual metal. Every percentage point you save on transaction costs is a percentage point added to your returns. Over time, over multiple transactions, over a full market cycle, these differences compound into massive amounts of money. You're not just saving a little bit. You're potentially improving your returns by 20, 30, even 40% compared to traditional physical ownership. That's the difference between a good investment and a great investment. That's the difference between building wealth and just treading water. The backdoor method to owning bullion isn't a secret because it's hidden. It's a secret because most people don't take the time to understand how the system actually works. They default to what feels familiar. They buy coins because that's what everyone talks about. They pay premiums because they don't know there's an alternative. But you're not most people. You're someone who's willing to look deeper. You're someone who's willing to question the conventional wisdom. You're someone who's willing to play the game the way the smart money plays it. So here's my challenge to you. Go verify what I've told you. Look up these products. Check the bar lists. Compare the costs. Run the numbers on your own situation. See for yourself how much money you can save and how much more efficient your precious metals ownership can be. The information is out there. The products exist. The infrastructure is in place. All you have to do is take action. Stop overpaying for the privilege of holding metal in your hand. Start owning it the way professionals do. Spot price, instant liquidity, professional storage, maximum efficiency. That's the backdoor method. That's how you own bullion without getting destroyed by premiums, discounts, storage costs, and illiquidity. That's how you turn precious metals from an expensive hobby into an efficient wealth-building tool. The choice is yours. Keep doing what everyone else does and accept the costs, or use the backdoor method and keep more of your money working for you. The metal is the same either way, but your returns won't be.